Hello and welcome to the Daily Brief Show. Today is Monday, the 9th of September, and I have three interesting stories for you. In the first one, I talk about how the Indian government is conflicted on EVs. In the second story, I talk about household consumption and how it is exactly calculated. And in the third and final story of the day, I talk about how India's steel sector is struggling because of China. So let's begin. Now, look, in the first story of the day, I wanted to talk about the EV market in India because there are some very interesting developments and also a bit of a mixed messaging from the government of India. I'll give you some context. Look, back in 2015, India launched the Faster Adoption and Manufacturing of Hybrid and Electric Vehicles or FAME scheme with an allocation of 895 crore rupees. The goal was largely to boost electric vehicle adoption and manufacturing in the country. FAME 2, which kicked off in 2019, was a bigger scheme with a budget of about 10,000 crore rupees. It aimed to incentivize the sale of about 15 lakh electric two-wheelers, three-wheelers, cars and buses. But as the FAME 2 scheme was winding down, the government introduced a temporary scheme called the Electric Mobility Promotion Scheme or EMPS, which is set to expire on 30th September this year. Now let me give you some numbers here. First, EV adoption in India has been growing for sure, but it is still in single digits. We're looking at about 2% of total vehicle sales being electric, which is not bad, but there's clearly room for growth. Second, in 2023, electric car registrations were up 70% year on year compared to a growth rate of under 10% for total car sales. This trend indicates that growth remains robust as the market matures. Now, what is interesting is the shift we're seeing in fuel preferences. According to a report by Care Edge Ratings, the share of petrol vehicles in total sales has dropped from 86% in 2020 to 76% in 2023. Meanwhile, alternative fuel vehicles, including EVs, have seen a 400% growth in the same time period. That is significant, even if it is from smaller bases. One of the biggest selling points for EVs has been the total cost of ownership. CareEdge's analysis shows that over a vehicle's lifetime, EVs currently offer the lowest cost, followed by CNG vehicles. This factors in not just the purchase price, but also fuel costs, maintenance costs, and government incentives. For example, their estimates show that the net cost of ownership for a petrol car over its lifetime is at about 28.38 lakh rupees as compared to 16.7 lakh for an equivalent EV. Now that is pretty compelling as a difference. But here is where things get a little bit fuzzy. See, we've got two senior government officials saying two very different things about the future of EV subsidiaries. On one hand, we have Union Heavy Industries Minister H.D. Kumaraswamy saying that FAME 3 is in the works. Just last week, he said that the government is expected to finalize the third phase of the FAME scheme in a month or two. An interministerial group is apparently working on it and trying to address issues from the first two phases. But then on the other hand, we've got Union Transport Road Minister Nitin Gadkari saying exactly the opposite. In a recent interview, he suggested that the era of EV subsidiaries might be coming to an end. He said that with increasing demand and production volumes, costs are naturally decreasing, which potentially eliminates the need for government subsidiaries altogether. Now, Mr. Gadkari highlighted India's focus on import substitution of cost-effective homegrown EV technologies. He pointed out that the GST on electric vehicles is only 5% as compared to 48% on petrol and diesel vehicles, which he considers a significant advantage for EVs. So what is going on here, you might be wondering? Look, it's possible that we are seeing a debate play out in real time about what the future of EVs in India looks like. Mr. Gadkari's view seems to be that the industry has matured enough to stand on its own, while Mr. Kumaraswamy's comments suggest that there is still perceived need for government support. Now, this uncertainty is definitely causing some concerns in the EV industry, especially with the festive season coming up. October is typically a big month for vehicle sales in India, with both Navratri and Diwali falling in the same time period. EV manufacturers are worried about a potential gap in subsidies if EMPS expires and FAME 3 isn't ready to go yet. Some industry players are calling for either an extension of EMPS or a quick rollout of FAME 3 to ensure continuity in subsidies. The concern is that a sudden halt in incentives could impact sales heavily, particularly during this crucial period of sales. However, Mr. Gadkari still seems confident in the industry's ability to stand on its own right now. He expressed optimism about India's potential to become a global manufacturing hub for EVs, and he stated, and I quote, "My dream as a transport minister is that within 5 years, with alternative fuel and biofuel, we want to make India as number one manufacturing hub in the world." Now, this ambition is supported by initiatives like the PLI or the Production Linked Incentive Scheme, which aims to boost domestic manufacturing. In summary, though, it is clear that the Indian EV market is at a big crossroad right now. The government's next move will be crucial in shaping the industry's trajectory. It'll be interesting to see which view prevails. Will the industry see a continuation of subsidies under FAME 3, or will the industry be able to stand on its own now? Mr. Gadkari also emphasized the potential of various alternate fuels beyond just battery electric vehicles, inclusive of CNG, LNG, ethanol, methanol, and green hydrogen as well. He stressed on the importance of reducing costs while maintaining quality in order to make Indian EVs competitive both domestically as well as internationally. Now, the other big hurdle for electric vehicles to take off in India is the lack of charging stations. Regarding charging station infrastructure, Gadkari suggested that market forces should drive development, and he said that there are opportunities for people to take advantage of this. One thing's for sure though, with the global push towards cleaner transportation and India's own ambitious climate goals, the EV sector will definitely remain a key area to watch out for. The government's final decision on subsidies could have far-reaching implications for the auto industry as well, so we'll just have to wait and watch. Moving on to the second story of the day, a couple of days ago on this show, I talked about how Indians are spending less. Many of you asked in the comments how this is exactly measured. Luckily for you, SEBI published a new research paper on the topic, and I thought it would be a great idea to start the story by explaining how Indian household savings are calculated. Look, the formula for household saving is quite simple. Household savings are basically gross financial savings minus financial liabilities plus physical savings. I know that sounds complicated, so let me explain these components simply. Gross financial savings includes deposits, investments in mutual funds, stocks, bonds, etc. Physical savings includes investments in physical assets like real estate or gold. Financial liabilities refers to household debt like loans or advances. Now, these numbers are important because they show how much savings are available in the country. Businesses can use these savings to get money in order to expand their business, and the government can also borrow from this pool of capital in order to spend on the country's development. The RBI and the Ministry of Statistics and Program Implementation, or MOSPI, regularly publishes statistics on household savings and investments. I'll give you a quick brief idea on what some numbers look like in India as of FY 2023. First, gross household savings have doubled from 23.5 lakh crore rupees in FY 2012 to 65.2 lakh crore rupees in FY 2023, which is an annual growth of 9.72% over the last one decade. Second, physical assets, especially real estate, gold, etc., make up over 70% of household savings today. Third, net financial savings have dropped by 40% between FY 2021 and FY 2023. Now, an interesting trend here is that there is a growing portion of financial savings that is being invested in the stock market. Now, this is good news because people are slowly moving away from traditional options like savings accounts, fixed deposits, gold, etc., to market-linked investments. But SEBI is not happy with how RBI and MOSPI calculate the total household savings. Earlier last week, they released a working paper proposing a more comprehensive methodology to calculate this. In their paper, they raised concerns that household savings through the Indian securities markets are not captured fully in the statistics published by RBI and MOSPI. SEBI had three broad issues with how calculations are being done right now. First, RBI's current method only considers certain groups like retail investors and high net worth individuals. SEBI suggests including all individual investors and non-profits, which are currently missing. Second, the current methodology only tracks a limited range of financial products like equity, mutual funds, etc. SEBI proposes including secondary market transactions and newer instruments like REITs, InvITs, and ETFs for more accuracy. Third, certain important savings data such as alternate investment funds or private placements and other newer financial products are not captured in the current system. SEBI wants to include these to better reflect the full picture of household savings in India. Basically, because of these gaps, household investments in the stock market are being undercounted, and SEBI wants to fix exactly this. According to SEBI's own calculations, Indians are saving more than what they previously thought. Also, the current RBI numbers show that physical savings accounted for more than 71% of household savings in FY 2023, which is the highest proportion since 1970. Based on SEBI's calculations, Indian households may be less reliant now on physical assets and more invested in financial assets than we have realized so far. So, yes, this is definitely good news. Now, moving on to the third story of the day, I'll talk about how India's steel industry is struggling because of China. Look, the world produces about 1.8 billion metric tons of steel each year, which, to put in some very fun context, is the weight of about 180 million elephants. China is by far the largest player and has over 50% of the market share. India, on the other hand, has about 6 to 7% share in the market. But lately, the Indian industry has been facing some serious challenges, and I thought it is worth understanding what's going on. Look, one of the biggest problems currently is that China is dumping cheap steel into markets like India, often at prices below the cost of production. This is happening because China has built way too many steel factories over the last decade or so due to its massive spending on infrastructure and manufacturing. But in the last 5 odd years or so, China has been steadily slowing down. And this is happening because of the implosion of China's real estate and construction sector, which accounts for over 30% of its GDP. Now, because of the trillions that China has invested in building physical infrastructure and industrial bases, China's factories are now making much more steel than they need. At the same time, China's domestic consumption has reduced significantly, which is forcing them to sell all this extra steel to other countries at dirt cheap prices. To give you some numbers, the recent cost of steel from China in India was roughly at about 48,000 rupees per metric ton, which is far lower than India's price of about 51,000 rupees per metric ton. Mind you, steel is a very low margin commodity, and while the difference in absolute terms might sound small to you, it makes a huge difference to buyers. As a result of this pricing, in July 2024, Chinese steel made up 73% of India's total imports, which is the highest number in the last 7 years. This flood of cheap steel is now hurting domestic producers because they just cannot compete at such low costs. By the way, Japan is also currently exporting steel to India at prices very similar to that of China. But the reason is a little different. Japan's low prices are not because of dumping, but because of a free trade agreement with India. This agreement cuts down tariffs and trade barriers and makes it easier and cheaper for Japanese steel to enter India without breaking any trade rules. But given that Japanese prices are still lower than India's own prices, this is definitely hurting Indian steelmakers. Now, back in India, there is a lot of talk to protect steelmakers from cheap foreign imports. Steel Minister H.D. Kumaraswamy wants to raise import duties from 7.5% to 10 to 12% in order to tackle Chinese steel. On the other hand, Commerce Minister Piyush Goyal is suggesting a border adjustment tax or BAT to balance the taxes paid by Indian producers. The problem, however, is that there are doubts if BAT would make a big difference since it might only slightly increase import prices. This lack of a clear and unified approach is leaving the industry in a bit of a tough spot. So in all, the global steel market is currently in a state of bad chaos, especially for emerging countries like India because of China's aggressive strategy to export domestic problems to the rest of the world. Currently, India's steel industry is pretty much squeezed from all sides, and it'll be very interesting to watch how these shifts take place in the coming few quarters. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.